Now we're going to take a look at how credit works. Before we jump into debt, we're going to take a look at credit because everybody, for the most part, is concerned about credit one way or another. The most common question people have, regardless of the option to get out of debt, is how is this going to affect my credit? What a lot of people don't know is even how what they're doing right now is affecting their credit. So let's take a look at my world-famous three-legged stool analogy of how credit works. So imagine, if you will, a three-legged stool. And obviously on the stool there are three legs, and that's going to represent each of these main areas of your credit because each of these three areas make up about a third of your whole credit score. We could go into the complexities of credit scoring algorithms and all this kind of stuff. But this analogy will make it simple and clear so you understand it and you're never confused about it again. The first leg on the three-legged stool is your payment history, just simply a record of whether or not you've made your payment. And here's some important distinctions about how the payment history works. Some of the stuff you might think is not fair, but I'm not here to tell you that it's fair. I'm here to tell you how it works. A good payment history is a perfect payment history. The reality is that the first late payment you get is the one that will knock your score out of the sky. It'll knock the wind out of your sails. A lot of times your credit score will drop 100 points or more just from the very first late payment. So a bad payment history is if you've ever been late. If you've ever been late more than 30 days. If you're late one day or a week, that's not going to show up on your credit report, although it might trigger an interest rate increase or an increase in your minimum payments. But after you're 30 days late, it will be reported on your credit. It'll stay on there for 7 years. So the important distinction about the payment history number one is that the very first late payment you get is the one that does the most damage. If you have a perfect payment history, then you've got a good payment history and you've really got something to lose. If you've already fallen behind even once, then most of the damage has been done. Another rule of thumb here to consider about the payment history is that time is your friend. Time is your friend with payment history either way. The longer you have good credit, the more it's going to count towards you. The longer that it's been since you've had bad credit, the longer it's been since you've been late, the less that's going to weigh against you. For instance, if you have late payments in the past 6 months or the past year or two, those are going to affect you much more than if they're a few years old. You're going to stay on your credit report for 7 years if you don't get them deleted. But even if it's still on your credit report but it's 5 years old, that's not going to affect you nearly as much as something from the past year. Time is your friend. Now, crippled payment history. On each of these three legs, we'll look at good, bad, and crippled. Crippled payment history is if you're past due. If you're past due right now, you're probably not going to be able to get any kind of loan. Maybe you can get more credit cards because they hand that stuff out like crack cocaine. But you're probably not going to be able to do anything with a mortgage or a car or anything like that. Second leg of the three-legged stool is your debt-to-income ratio. To figure out your debt-to-income ratio, what you do is you add up all of your minimum monthly obligations towards debt and divide that into your gross monthly income. So we're not talking about cable expenses or cell phone bills or utilities or expenses. We're talking about monthly payments that you're obligated to pay on debt, minimum payments on your mortgage, auto loan, student loan, credit card debt, consumer debt, child support, IRS debt, anything that you're carrying, those monthly payments are going to be counted against your debt-to-income ratio. A good debt-to-income ratio is less than a third. So I would say you had $3,000 a month gross income. If you're paying $1,000 or less per month on debt, that includes mortgage, car, credit cards, all the above, then you're in good shape. That's where you want to be. If you're there, congratulations. If you're not, that's where you want to get to. Whether you increase your income or reduce your debt expenses, that's the goal. A bad debt-to-income ratio is when you get into about a third to a half. A third or half of your money each month is obligated to pay debt. Now, the closer you get to that halfway mark, the harder it is going to be to get financing. It's going to limit what you get. A few years ago, the debt-to-income ratio was allowed to be higher. With the mortgage crisis, underwriting guidelines have gotten stricter, and a lot of times even something over 45% will cripple you. However, this is just a general rule of thumb. Sometimes, depending on your situation, you might be able to get a mortgage loan all the way up to 55, 60, 62% of your income. If you do get that kind of a loan, then your loan officers are going to be talking about it at the water cooler saying, hey, I just got this guy FHA 62%. And it's a rare thing. So these are general rule of thumb. But for the most part, your debt-to-income ratio is over a half, sometimes even over 45%. You're crippled, effectively crippled. We're going to talk a little bit about credit score and credit worthiness, and keep this in mind. Third leg of your three-legged stool is your debt-to-credit limit ratio. Now, this is the most misunderstood or least known about piece of your credit. We're going to talk a little bit about how the new laws affect this and some strategies to really improve this area of your credit. But your debt-to-credit limit ratio is simply how much of your available credit you're using. A good way to think about it is each account you have has a current balance and a credit limit. If that current balance is under 50% of your limit, that's a good debt-to-credit limit ratio. There's a sweet spot in there. The best place to keep it is about 20 to 25%. You might think, well, hey, I charge up my credit cards and I pay them off every month. And that's financially a great habit to do. As far as your credit is concerned and how the creditors see you, that can actually harm your credit because they see you as what they call a deadbeat. There's a program that came out in 2004 from PBS Frontline and the New York Times called The Secret History of the Credit Card. And it won the award for best journalism that year in 2004. It's a little bit dated, but it's got a really good information. You can find it online. If you Google that, Secret History of the Credit Card, PBS Frontline, you can watch it for free online. That's one of the things that they discovered is that if you don't carry a balance each month, if you pay your credit cards off every month, creditors will consider you and label you as a deadbeat because you're basically using their money for free. The best spot is to keep it about 20, 25%, or roughly a quarter of the limit, carrying a balance each month. That way you're paying them a little bit of interest and you look like an ideal customer to them. So this is going to be important when it comes to credit building or credit rebuilding. A bad debt-to-credit limit ratio is when you're over halfway utilized, when your balances, whether it's one account or all your accounts combined, if they're over 50% of the credit limit, that becomes bad. And it gets worse the closer it gets to being maxed out. Crippled, as you might guess, is when you're maxed out or over the limit. You're not going to be able to get financing if you're over the limit or maxed out. You're going to have cash to pay those balances down and get that debt-to-credit limit ratio or your utilization under control. So there you have the world-famous three-legged stool of how credit works. And all three legs, your payment history, debt-to-income ratio, and debt-to-credit limit ratio. Question is, how is your credit right now? And you should have this in your workbook, so go ahead and write this down. Make sure you understand each of these. And if you have any questions, I'll go over those in a second. The first leg of your credit, your payment history, is it good? Is it bad? Is it crippled? Second leg, your debt-to-income ratio. Is that good? Is it bad, or is it crippled? And your third leg, debt-to-credit limit ratio, good, bad, or crippled. Figure out where you're at right now yourself and write that down in your workbook. It's very important to know where you're at now because how your credit will be affected depends on where you're at right now.